Brace yourselves for a week packed with market action, economic shifts, and potential stock movements. Whether stocks soar or dip, we're here to guide you on how to profit in this dynamic market. Join me as we navigate the intricacies of the week's stock market developments. A staggering 23% of the S&P is set to report earnings, and the impact is substantial. Notably, Microsoft, Google, Apple, Amazon, and Meta collectively contribute a whopping 24% to the total market cap of the S&P 500. In this video, we'll break down the key factors and strategies to help you navigate this week's market's events. Stay tuned for the insights that can shape your investment decisions in the days ahead. Amidst the market buzz, let's not overlook the highly anticipated Fed rate decision stirring excitement and speculation. Many are speculating on potential Fed cuts this year, prompting a closer look at the implications for the economy. While the market expects no rate change, the focus shifts to what the Fed communicates during the meeting. Are there concerns? And how does the recent significant drop in core inflation factor in? With the Fed targeting a 2% goal and the recent data showing a core inflation below 3%, there's room for analysis on whether they'll maintain the status quo or a significant shift. Navigating the economic landscape is unpredictable and anything can happen. Despite the speculation, 7 rate cuts this year, the likelihood seems improbable. During this quarterly earnings season, we view it as a strategic opportunity to witness the substantial increases on our existing investments or make new acquisitions during market pullbacks. As we previously emphasized, this year presents a selective market where a handful of stocks will drive the overall index performance, making it a stock picker's market. Our focus for earnings season is on capitalizing on pullbacks to our current positions. Consider buying on the dips as a chance to acquire stocks at a discounted price. Think of it as taking advantage of a market sale. The key is to be prepared for market downturns, having cash ready to seize investment opportunities when prices drop. Looking ahead, while we anticipate opportunities to short the market in 2025 and 2026, the current trend in 2024 remains buying on the dips, specifically in selectively strong uptrending companies. Today, among the plethora of indicators we analyze, one stands out is the Rydex Index Indicator, specifically examining the NOVA divided by the Ursa ratio. This indicator involves dividing the NOVA Rydex fund by the Ursa ratio, providing insight into the equity market sentiment. The NOVA fund aims to match 100%, 150% of the daily performance of the S&P 500, while the Ursa fund is an inverse that tracks the S&P index on a one-to-one basis. Some key takeaways. The NOVA Ursa ratio serves as a market direction sentiment indicator, utilizing Rydex mutual funds as a numerator and a denominator. Rydex NOVA funds follows a bullish strategy where the Ursa fund adapts a bearish strategy. Fluctuations in assets between these funds can act as a proxy for investor sentiment. Examining the Rydex divided by Ursa ratio sentiment indicator, we currently observe extreme levels at 300. Indicating a highly bullish sentiment. Based on this chart, I anticipate a potential pullback in the market. This pullback might be slight, but there will be a pullback. Expect 1 to 3 of the Magnificent 7 this week to fall after earnings announcements, but this will be an opportunity in the coming weeks to buy on the dips certain selective securities. Before we get started, disclaimer. The information provided on our channels for educational information purposes only is not intended to be a substitute for professional financial advice. You need to protect your capital by all means. These are only recommendations. Please speak to a financial advisor. We use a 3-part process. We look at the overall market, break it down into the certain sectors, and then to the individual securities. This video continues our journey with individual securities. We'll be looking to buy on pullbacks. We look at the sector and then the individual security. We continue our investment recommendation on Qualcomm, which announces earnings on Wednesday night. On November 27th, we gave our first initial bullish recommendation around the current price, where it is now of 149.64, and a buy-in price at 127, which gives us an 18% gain. Why are we bullish on Qualcomm? First of all, if we look at the XLC, the communication sector, we can see that this is clearly on an uptrend, trading above the moving averages, and is in a very strong group. So the sector that we're picking in, Qualcomm, is very strong. If we look at the security itself, it is clearly on an uptrend. It is clearly trading above the moving averages. And these are one of the securities that we are selecting to be higher, even at these prices, 1 year from now. But we would like to buy on pullbacks from 135 to 140 because it has become quite extended. We have a long-term position open on Qualcomm, but we do not have an intermediate and short-term positions open on Qualcomm. Let's go through our investment philosophy when buying. Are we in a bull market? We feel because of the presidential election, we are in a bull market. Is Qualcomm oversold? With the pullback because of the Rydex ratio and other factors, we will have a pullback and we will get a position to buy on the dips on Qualcomm. Is Qualcomm cheap? No way. It has clearly went up close to 40% in the last 4 months. Is Qualcomm on an uptrend? Yes, Qualcomm is on an uptrend. Will we put in stop losses? Correct. Have we maintained consistency on our system? Yes. If you look at our short-term overbought, oversold, the short-term is 3.95, which gives us a good opportunity, but the medium, long-term, and exit swing is sort of in the middle. So we will be holding off for more of a sell-off to purchase in the position. If you also look at the CCI Commodity Channel Index, it will probably come close to 0 or a little bit below 0 and then turn upwards. So we'll really be looking at the CCI Commodity Channel Index to help us for the intermediate and short term for this pullback. Remember, our overbought, oversold components, which takes all of the NASDAQ 100 and many other indexes at a reading at 45.19, we would love it to be at 27 to 20 to officially buy in. But the RMO, Rahul Mahinder Oscillator, on all 3 levels are bullish, but the exit swing signal is saying wait for a pullback. In conclusion, like we told you yesterday, Microsoft, Google, and now we're adding Qualcomm to the earnings list. We will wait for a pullback and then buy on the dips. This is the strategy that has worked very well for us last year, and we continue to believe this is the strategy to go going forward on selective companies trading above moving averages. You know the catchphrase, study it, analyze it, adapt it. Peace.